Earnings season, your guide to the corporate scorecard. Hello, fellow investors. Get ready for earnings season, a time when companies reveal their financial performance. This period is crucial for anyone involved in the stock market, from seasoned investors to newcomers. It's like a report card for businesses. Just as students receive grades to show their academic performance, companies provide earnings reports to showcase their financial health. Every quarter, companies listed on the stock exchange tell us how much money they made and spent. These reports include key metrics such as revenue, net income, and earnings per share. This information is crucial for investors. It helps us gauge the company's performance and compare it with market expectations. It helps us understand if a company is on the right track or not. Positive earnings can lead to stock price increases, while negative results might cause a decline. So, buckle up and let's decode these earnings reports together. Understanding these reports can give you a significant edge in making investment decisions. Think of earnings season as a financial health checkup for companies. Just like a doctor examines a patient to assess their health, we analyze these reports to evaluate a company's financial condition. We get insights into their profitability and future prospects. These reports often include forward-looking statements that can give us clues about the company's future plans and potential growth. This information empowers us to make informed investment decisions. By understanding a company's financial health, we can decide whether to buy, hold, or sell its stock. Are you ready to become an earnings season pro? Let's dive in. With the right knowledge and tools, you can navigate this season with confidence and make the most of the opportunities it presents. Decoding the earnings report. What's inside? Earnings reports might seem complex, but they're like financial stories. They provide a detailed narrative of a company's financial performance over a specific period, usually a quarter. They tell us how a company performed in the past quarter. This includes insights into their revenue, expenses, and overall profitability. These reports are public documents. This means anyone interested, from investors to analysts, can access them. You can find them on company websites or financial news platforms. They are usually released quarterly and are a treasure trove of information. Now, let's break down the key elements of an earnings report. Understanding these elements can help you make informed decisions. The report includes revenue, which is the total money a company earned. This is often broken down by different segments or products. It also shows expenses, the money spent on operations. This can include costs like salaries, rent, and utilities. The difference between revenue and expenses is the company's profit or loss. This is a crucial indicator of financial health. Understanding these basics is the first step to deciphering the financial health of a company. By analyzing these reports, you can gauge whether a company is growing, stable, or in decline. This knowledge is invaluable for making investment decisions. Revenue, net income, EPS. Unmasking the financial jargon. Let's simplify three crucial terms: revenue, net income, and EPS. These terms are often thrown around in financial discussions, but what do they really mean? Revenue is like the total money earned from selling a product, say smartphones by Apple. It's the gross income before any expenses are deducted. Think of it as the top line of a company's income statement. Net income, on the other hand, is the profit after deducting all expenses, like the cost of making those iPhones, salaries, rent, and other operational costs. It's what remains after all the bills are paid, often referred to as the bottom line. EPS, or earnings per share, tells you how much profit is allocated to each share of the company's stock. It's a key indicator of a company's profitability and is calculated by dividing the net income by the number of outstanding shares. Imagine a cake, net income, divided into slices, shares. The more slices there are, the smaller each one will be. EPS is the size of each slice. A larger slice means higher earnings per share, indicating better profitability for shareholders. These metrics are key to understanding a company's financial performance. By analyzing revenue, net income, and EPS, investors can gauge the financial health and potential growth of a company. So next time you hear these terms, you'll know exactly what they mean and why they matter. Reliance Industries, a case study in consistent growth. Let's take Reliance Industries, a giant in the Nifty 50 index. They've consistently grown their revenue over the past years. This indicates strong demand for their products and services. Investors love to see revenue growth. It signals a company's ability to expand its market share and profitability. Consistently exceeding revenue expectations often translates into a higher stock price, rewarding investors who believe in the company's growth story. Section 5. Infosys. When beating expectations sends stocks soaring. Remember Infosys? This IT giant exceeded analysts' EPS expectations last quarter. Guess what happened? Their stock price shot up. When a company beats EPS estimates, it often triggers a positive reaction from investors. It shows they're managing their finances well and generating higher profits. This positive sentiment can translate into increased demand for their stock, driving up the price. Section 6. Technical Analysis. Charting the impact of earnings. Now, let's add another layer: technical analysis. It's like reading the stock market's mind by analyzing charts. Technical analysts believe that historical price movements and trading volume can predict future trends. They use tools like moving averages, RSI, and MACD to identify patterns and signals. Earnings reports often act as catalysts, causing significant price movements that technical analysts closely observe. Section 7. HDFC Bank. Riding the waves of earnings reports. Take HDFC Bank, another heavyweight in the Nifty 50. Their recent earnings report missed analysts' expectations. As a result, we saw a dip in their stock price. Traders and investors reacted to the news, causing a shift in supply and demand. Technical analysts would have observed these price movements, using indicators to confirm the bearish sentiment and potentially adjust their trading strategies. Section 8. TCS in real time. Putting theory into action. Let's do a real-time analysis of TCS, another IT major. They just announced their earnings, beating expectations. We see their stock price trending upwards in pre-market trading. This immediate reaction suggests positive investor sentiment. Technical indicators like the RSI and MACD would likely reflect this bullish momentum, potentially signaling a further upward movement in the stock price. Section 9. Fundamental plus technical equals informed investing. See how understanding both fundamental and technical analysis can be powerful? Earnings reports provide the fundamental insights, while technical analysis helps us interpret market sentiment and potential price movements. By combining these approaches, we can make more informed investment decisions. Remember, knowledge is power in the stock market. Section 10. Ready to dive deeper. Join the journey to financial literacy. Congratulations on completing this earnings season crash course. You've learned about key metrics, real-world examples, and the power of combining fundamental and technical analysis. But this is just the beginning. Subscribe to our channel and hit the notification bell for more insightful content. Let's empower ourselves with financial knowledge and navigate the exciting world of investing together.